Hello, hello. Welcome to the Warrior Stocks podcast presented by Achaon.com. My name is Max Beach, and let's get to it. Please note that the content of this podcast is for informational purposes only and is not intended as investment advice. The opinions and views expressed on the podcast are solely my own and do not reflect the opinions or views of my current, past, or future employers. Welcome to the seventh episode of the Warrior Stocks podcast, everybody. I know there was a bit of a delay. I meant for this episode to come out on Wednesday, but here we are now. I was working on the Disney Post earlier this week, which, if you're also new to Achaon.com and the Warrior Stocks podcast, welcome again. If you want to check out everything I've put out onto the investment universe, go check out the website at Achaon.com. And yeah, so this week I was working on the Disney Post. It's probably some of the best writing I've ever done because I think I had some of the most fun writing it that I've ever had. And I've been reading more this week, and I had some junior Husky basketball camps to help out with. So, been a bit of a busy week for me, but it's good to get onto the podcast today. We're going to do a lesson on valuation, or more about the concept of value and building on our idea of stories, because stories are great. It helps us understand a stock and understand what's going on. But at the end of the day, if even if there's a great story surrounding a stock, if it has no value or if it's not undervalued, it's not going to be a good stock idea. So we really need to nail down a definition of value before we get started. All right, we're going to get into it. Yep. We value items every single day. You value your time, you value your savings, and you value every time you buy something at the store. You think that the price is at value. You might think that a price is a little too expensive, or you could think that some price is a little too cheap and that's why you're buying it. So when we're thinking about the application of value to stocks, we need to understand what stock looks expensive, what looks like fair value, and then what looks undervalued. And the problem with just looking at a stock story without understanding a story's value is like choosing what to wear with your eyes closed. Because when you open your eyes, you might have a great outfit, or you might have a neon shirt and pink neon pants, which, some people might like and some people might do well with, but other people might not like that. And when it comes to stocks, you might really love a story, but then you buy it and you don't realize that it actually is worth half the cost, or it really should be double. So this is what we're going to get into, and what we're going to be looking at. For now, before we get into expectations or even multiples, at the end of the day, what we want to see is we want to look for companies that will be around in the future and making more money in the future than it is making today. Going back to what we were talking about a few episodes ago with Shark Tank, the whole reason why the sharks are buying into these small niche companies is because they believe that the companies will have better margins in the future. They believe that through their expertise, they can attain higher levels of revenue in the future because of the sharks' help. And so that's what we want to see out of our stocks. We might not be the sharks that can go into business and actually help it, but we can learn everything we can about the business and look at the financials and predict that, yeah, in the past the margins have been really steady. So I think the margins are going to be steady in the future. And if there's any kind of revenue growth, that means that it'll fall to the bottom line since margins are staying steady. So over time, the company is going to be making more money. If the company is making more money, thus we should be valuing it higher, or the market should be valuing it higher in the future. And that is where you can actually break down why a stock should be worth more in the future. But then you might have a stock trading at, let's say, Nvidia levels, where the expectations are so high and the multiples are so high that the expectation of growth is just maybe too much or too high when there's other opportunities on the market. And now we need to get into expectations and multiples. We want to know what the market's expectations are for a story and how it's being valued. Because let's say that you have a stock, let's just call it Yoda stock. And Yoda, you project it to grow by 10% each year over the next 5 years. If you look out into the market during your research process and noticed that analysts are also thinking that earnings are going to grow by 10% each year and it's trading at a high multiple, it's likely that even if the company does what you think and you're actually right about the story, that story is already being valued. So if that story plays out exactly as expected, you're probably looking at a flat stock. But if, say, your company grows by 15% each year, then you're probably looking at a real awesome performer over the next 5 years. And then there's the counterexample. Say your company contracts 5% each year, then you're looking at a stock that you're probably losing a ton of your money on. And even if you don't have access to analyst reports to see what the sell side is valuing your company at, we use multiples as a way to see how high or how subdued expectations are. The first multiple that we'll go over on the Warrior Stocks podcast is the price to earnings multiple, because my expectation is that if you're looking or you're interested in getting accustomed to learning a stock story or diving deep into a company, I would want you to choose a profitable example for now, or a profitable case study. And we can value profitable companies using the price to earnings multiple. So, what is the PE multiple? So, price to earnings. Basically, what the number is, it's a ratio. It's the market capitalization. So, all the shares outstanding times the share price divided by the last 12 months of a company's earnings. Okay. That might be a little too deep. So let's think about this example. This is the easiest way that I've been able to understand a price to earnings multiple. Think about a house, right? And a house, you're looking to buy it for $1 million. So you buy the house for $1 million and you think, okay, I now own this house, but I also have my parents' place and I can still live there for a little bit. What can I do? Well, I can rent it out for $100,000 a year. So basically, the PE multiple on your house is 10 times because it's worth $1 million, but you can collect $100,000 a year from the rent. So basically, you're valuing the house at 10 years worth of rent. So when we're looking at a stock, let's say Yoda stock, and it's worth $1 million outstanding, and the Yoda company made $100,000 last year, and we're expecting it to make $100,000 next year, the Yoda stock is trading at a 10 times multiple. And so then let's say you're looking at another stock in Yoda's, it's one of Yoda's competition, and it's Solo stock. And Solo stock is also trading at $1 million, but its PE multiple is 20 times. So that means that Solo is actually making $50,000 a year, whereas Yoda is making 100,000 per year, but people are valuing Solo stock for some reason over Yoda. But that doesn't make a ton of sense because Yoda can use the Force and Han Solo is just a cool guy. All right. But does that kind of make sense? Because that's what we do when it comes to stocks. Let's say you're looking at JB Hunt versus Hub Group. They're both transportation companies, but JB Hunt is probably number one in transportation, whereas Hub Group specializes mostly in intermodal. So the market itself values JB Hunt more than it values Hub Group. And JB Hunt makes higher earnings, and there's a reason why it should be worth more. And just a final way to think about a price to earnings multiple for now is that a company with a high price to earnings multiple, or one that is significantly above what the market multiple is a company that the market is expecting high future growth in earnings, or it's a really big growth story. Like, I think that earnings are going to grow 50% each year rather than 10%. And something that has a P multiple that is quite low doesn't mean that it's cheap, but it means that there's low expectations for earnings growth in the future, or that earnings might not be growing in the future. Maybe there's an expectation that earnings are going to slow down in the future. And there's different ways to take advantage of value, right? Say a company that the market is expecting slower growth in earnings. Well, maybe you find a story that you think will actually grow faster than that low expectation. Like, say there's a boat company, or not a boat, but like a shipping, like those giant tankers. And the expectation is that revenue isn't going to grow that much for those companies. But you know that they're actually building 4 or 5 new boats that are gonna be hitting the waters in 2026, but the market isn't pricing that in because, or they're not valuing it because it's so far in the future. And so that's where you can find a story like that. Or you could look at something that does have super high expectations, but because the expectations are so high that if it beats those expectations even further, then that stock can still go up even higher in the future. Then the counter to that is that if there are really high expectations, and even if the company meets those expectations or falls slightly below those expectations, you could see the floor really come out of the stock. Whereas something that has those low expectations and those expectations aren't necessarily met, there might not be as much risk in those lower valuation ideas or those low PE multiples. And that's where you get into the concept of value investing and all that jazz. And so I can get into a quick example of mine. If you go to the Kaon website and go look up Orion Engineered Carbons, or OEC, you'll see a company that is a materials company, and it produces a substance called carbon black. And in the second half of 2024, there's going to be a supply constraint. And that was the story that I developed for this company. And it's still being valued at like 11 times, 12 times PE, when the overall market right now is worth maybe 25 times, I think, at this point. And so the reason why I'm so interested in it is because there's a story going on specific to carbon black, and there's not that many companies in it, and it's worth, 11, 12 times P, which doesn't seem like crazy high expectations. And this company is growing. There's a lot of regulations going into carbon black production, which is creating a larger economic moat for the company. And that's the whole story behind it. And it's not being valued like Nvidia or Google out on the marketplace. So that's why it's attractive to me. And that's a very value investing type of example. But another example, like I mentioned how there's, or maybe I didn't mention this, but there's other ways to use multiples. It doesn't just have to be valuing things based off of earnings. You could value companies based off of EBITDA. You could value companies based off of revenue. Using EBITDA and revenue usually happens when a company is unprofitable. So for a company like Redwire, RDW, the space infrastructure company that I recently wrote up, my interest in it is because the way that high growth stocks should be valued, or usually are valued, are these ridiculously high revenue multiples or ridiculously high EBITDA multiples. And for a company like Redwire that was trading, when I first looked at it, like a 1.3 times revenue multiple, that seemed cheaper on a relative basis. So you see how the way I valued OEC was a little bit different than the way I valued Redwire. Value isn't uh, a one-dimensional way to look at things. You really have to take in the kind of security you're looking at and the kind of market we're in. And that will help you contextualize how undervalued or overvalued a security is. And what we're trying to do, and I like to call it value investing, but it could be seen as growth investing too, is that we really want to look for stories that are being undervalued by the market. And that could look like an OEC, but that could also look like a red wire. Um, but that will come with experience and understanding the differences in the future. And we'll get into that. Like something like Redwire, I might have a larger margin of safety in than something like OEC, which might seem a little bit safer than Redwire since Redwire isn't profitable yet. And that's part of the thesis. So thesis building, understanding value, it all works together. It's just another piece of the pie that you have to understand when you're doing your bit of personal investigative journalism or investigative investing? No, investing investigations. I don't know. I thought that would have sounded a little bit more clever. But we'll wrap it up there. If you do have any questions about valuation, feel free to reach out. Again, apologies for this not coming out on Wednesday. Not that you guys were expecting it. Maybe I'm just apologizing to myself because I expected to have this out by Wednesday, but I'm glad it's getting done now. Is there anything that I wanted to talk about too? Um, no, I don't think so. The next few pods that we do that are more tutorial based, I think I'll get into more case studies now because we've gotten to a point where we understand the concept of value, we understand the concept of a stock story, that what we now need are reps and practicing understanding stories, understanding business models, understanding valuation. And then through that, we'll start getting into the more advanced topics of like margin of safety, sectors, and deep dives into competitor analysis and things that are cool and uh, more of the fun stuff. So we've kind of gotten past the bare bones fundamentals, and we'll also start sprinkling in the accounting and finance topics that I've wanted to talk about. I have a few notes here that I wanted to say at the end. Oh, just remember that a good story will be a company or industry that you understand, but then on top of understanding the company and business, you'll develop an understanding of how the story and industry is being appreciated by the market. And from that, you can say, hey, I actually think it's going to earn more in the future than the market. I think this industry is going to do a lot better. And that's investing at the simplest form it can be. And I'll end it there. So the next few pods will be cool. Um, I'll do a market update this weekend. No out of pocket Friday this week. Next week, we'll see. I think my week is a little less busy, so we'll be more active. I want to get more into writing and write things more like how the Disney post was structured. That was a ton of fun writing, and it flows a lot better than the other things. It's a lot more fun to read, so I'm noticing that when it's fun to write, it's probably going to be a more fun read or a funner read. I know it's not a word, but I like the word. Okay, we'll end it there. Continue the research. Sorry for the yapping. And continue to employ your curiosity and have a good rest of your day. See ya. If you want to learn more about Achaon.com, you can visit the website at Achaon.com. Achaon is spelled Achaion.com. You can also follow Achaon.com on Instagram, Twitter, and YouTube. The dot is spelled out DOT. Achaon.com.